In this particular video, you will get to know everything about EBITDA, all aspects of EBITDA that you should know as an investor. There are three aspects which I'm going to share with you in this particular session. And before you forget, please remember to share and subscribe so that others as well gain from this particular video. So coming back to the EBITDA, the three aspects are: the first aspect which you're going to know in this particular video is what is EBITDA, how it is calculated. The second aspect what you're going to know is what kind of companies focus more on EBITDA and EBITDA margin, and what kind of companies give less attention to EBITDA but attention to the other kind of profitability ratios. And the third aspect, which other investors would look into EBITDA margin and what kind of investor do not look into EBITDA margin. And the fourth and final, how is EBITDA really that important for you as an investor? So coming to first things first, EBITDA. What is EBITDA? EBITDA, as it says, earnings, E for earnings, B for before, I for interest, T for taxes, D for depreciation, and A for amortization. It is earnings before considering the interest, before considering the taxes, before considering the depreciation, and before considering the amortization of the company. Before considering all these aspects, the profitability amount, whatever you get, is the EBITDA margin. So now that you have known what is EBITDA, let us look at in little bit of depth what is ITDA actually represent, what it actually denotes. So when you talk about the I part of the EBITDA, which is being ignored from the EBITDA calculation, is the interest component. It's the interest which the company pays on the loans it has taken from the banks or other financial institutions. So this, I'm sure a lot of you are already aware about. You would also be taking home loan, and on those home loan you're paying interest. Likewise, the company invests on physical infrastructure for which it has taken loan, not only physical but other non-physical assets also it might have taken, for which it is paying the interest on the loan. So that is considered as part of the interest cost. Sometimes it is also called as the finance cost in some of the financial statements. So now that we have known the I part, let us look at the T part. T part, straightforward, taxes, whatever the government regulations are that has to be obliged by the company. The company has to pay taxes, be it companies or be it individuals. We have to pay taxes. There are some advantages for companies compared to that of an individual, but that's not part of this particular video. Maybe I'll cover that in a separate video. But nevertheless, T is for taxes, whatever the company needs to pay to the government, usually between 22% to 25% as of today. It could change going forward. In the past it was different. So the regulations and the tax percentage keeps on changing depending on the government attention to private companies. So then, now that we have understood the T part, let us look at the D part. The D is depreciation. Depreciation on physical assets. Depreciation is always on physical assets. For example, the company would have purchased a car. Even you would have purchased a car. That car gets depreciated over a period of time, right? So that depreciated cost is being considered as part of the calculation. So for example, if the company has purchased a large factory or large manufacturing unit, or maybe some computer stuff, whatever, all this bunched together form part of a physical asset, and this physical asset, the total cost is then divided into the number of years of its worth. Of course, if it is a factory, number of years of its worth is going to be more, like 10 years. If it is a computer, the number of years worth, it would be like 5 years. So accordingly, the number of years would be considered, and then the cost being considered as part of the calculation so that it can be ignored as part of the EBITDA. So now that we have known what is depreciation cost, let us see what is amortization cost. Amortization, just like depreciation, depreciation is on physical, what you can see, and amortization is also what you can see to an extent, but not physical in nature. They are copyright, trademarks like songs or some images, logos, which the company has spent on so that they can sell the products. This kind of trademarks and copyright create a consumer space. They have occupied a space in the consumer mindset, and the more number of consumers or more number of customers are accustomed to this trademark and logos, the more they buy the products, the more they think about these products, so that whenever they have to think about toothpaste, they think about that logo, C, Colgate, and they buy Colgate, or maybe Dabur to some certain kind of people. But the first instance is Colgate. Okay, having said about D and A, so now that you have known how to calculate EBITDA, so basically these aspects, that is the interest, tax, depreciation and amortization, is ignored, is not being considered in the EBITDA profitability calculation. So what is EBITDA? What is actually considered in the calculation is what I'm going to explain to you right now. So before you have, remember to subscribe, remember to share. Okay, so now what is being considered finally in the EBITDA profitability? So as we all know, company does this day-to-day operation. They sell products, they sell services into the market, and a result of selling these services into the market, or result of selling the products into the market, they earn something called as a revenue or the income. This is just the raw cash or raw income which the company makes into its pockets. So once it has acquired its income, how it has acquired its income? To sell the product, it needs to take raw material from its suppliers. So the cost of raw material is considered, and that cost of raw material is deducted from the income. So once the cost of raw material is deducted from the income, and also some aspects of this raw material will be in a finishing state, it would not be completely ready, it will be like in the process of being completed, or some of the raw materials would be in inventory, not yet sold. So all these three aspects, cost of raw materials consumed already and sold as well, and cost of raw material which are in progress of being consumed, and cost of raw materials, in fact, what has already been built but is kept in inventories. So all these aspects are considered as part of the cost deducted from the income, and that what you get is the EBITDA. So without considering the interest, taxes, depreciation and amortization is what is EBITDA. I'm just keeping on repeating it so that you are clear in your mind as an investor what is EBITDA finally. So now that we have known what is EBITDA, let us look into the second aspect, which is what kind of companies usually try to calculate EBITDA, try to focus more on EBITDA in the news, in their quarterly reports, on the annual reports. They focus more on EBITDA rather than the net profit. And there are this other group of companies which focus more on net profit, giving very less preference to EBITDA. If they consider EBITDA or net profit, it doesn't really matter to them. When you look at the startup companies, companies which have just starting to incubate, their startup cost is very high. They invest heavily into physical assets. They invest heavily into intangible assets. And as you know, they're just fresh. All these physical assets or intangible assets are all new, fresh, smelling fresh altogether. It needs to take some time. Right? All these aspects, whatever physical asset it has taken, acquired, for some of them, it would have taken loans. It would need loans for its working capital to run its day-to-day operations. So all these aspects, before it finally settles down, before it finally tunes down its operation, its cost actually turns out to be very high. So that the investor doesn't get diverted, into saying that, okay, now we have a startup and you have continuously only hearing about net profit being in minus, net profit being in losses. You would not be inclined to invest, isn't it? So hence, the next component of profitability which as an investor you need to check is the EBITDA. If the EBITDA is high, quarter on quarter improvements are there, year on year improvements are there in the EBITDA, then it is said that such kind of startup companies have a good weightage. Now, how much percentage of EBITDA versus revenue needs to be a justifiable amount? That is something which you need to study. There's a lot of videos floating around. I might also come across another video. I will make another video, in fact, to tell you what is the percentage margin which you should not consider as part of the EBITDA. So now what are these other companies which do not focus much on EBITDA? These are the matured companies. They have already recovered their capital expenditure on physical and non-physical assets. So these companies are more focused on finally the net profit improvement year on year. So the net profit needs to improve year on year by say whatever 15% or more. And if this is 15% and more, it's a great company to actually invest into with respect to the net profitability aspect. But there are other aspects as well, which is not the purpose of this particular video. But this matured company focus more on net profit margin. And to my expectation, net profit is what most of the investors, like an immature investor or beginner investor, needs to look into. And most of his allocation should be majorly into matured companies or companies which are doing net profit, having some good net profit improvements year on year. They may be slightly new, doesn't matter. But if they're startup companies, new, spend some years and doing net profit margin of like negativity or negative margin, negative profits, losses. So then you need to take a cautious view of such companies by looking into the EBITDA. And there are a lot of aspects apart from EBITDA which you need to consider when investing into a startup company. So now that you have understood what kind of companies focus more on EBITDA and what kind of companies focus lesser on EBITDA but more on net profit margin, let us look into the third aspect. What kind of investors, who amongst the ace investors focus more on EBITDA margins and EBITDA? If you are thinking that Mr. Warren Buffett focuses more on EBITDA margins, then I guess you're wrong. According to Mr. Warren Buffett, he stays away from EBITDA calculation most of the time. He focuses more and more on either the EBIT or the net profit margin, because that is the final cash which the investor actually gets into his pocket. Being a shareholder, I would invest in companies which is making some amount of cash, isn't it? I need to be an owner of such kind of companies. Or if you have a good view about the EBITDA margins and that in the next 1 or 2 years it's quick enough going to be paying off all its debt, all the capital expenditure, then you could have a different view altogether as an investor. But nevertheless, Mr. Warren Buffett thinks otherwise. Straightforward, no other view, just straightforward net profit margin is what Mr. Warren Buffett focuses on. So as an investor, you need to be very stringent with your rules, and Mr. Warren Buffett is stringent with his rules. So that is what I want to share in this video. And coming to the fourth aspect of EBITDA, how important is it? Most of it I've already covered. But nevertheless, just to summarize it, EBITDA going to be used for startup companies, and for matured companies, you do not look into EBITDA, you look into the net profit. So this is what I would like to summarize to you as an investor. And if you have liked this video, please share and subscribe. Do not forget, so that others gain the most by knowing about what is EBITDA at least, and all other subsequent videos which I am going to share coming into almost every alternate days. Okay, that's all. Tada.